All right, so quickly, for those that don't know about Blink Lending, haven't heard about us, we were founded in 2018. Very proud of our 340 plus five-star Google reviews. Simply, we offer cheaper, faster, and easier home loans. We do work with homeowners and investors. Our office is local, right here on Heights Boulevard, and we work with both active and passive investors. So if you have clients or yourself are an active investor, we have programs for you. And if you're a passive investor, we have programs as well. So by virtual show of hands, who believes this slide to be true? Knowledge is power. Okay, it's a trick question. And it's a trick question. And for those that have ever watched this cartoon, G.I. Joe, it always ends the same way. And the way is simply this: knowing is half the battle. As a kid, I had no idea what that meant. I'd ask my parents, grandparents, they'd giggle at me. One day it clicked. Knowing is just half the battle. If I don't take the action behind the knowledge, well, it's meaningless. I often like to give a metaphor of Valentine's Day. For those of us men who are in relationships, we know there's a Valentine's Day. Now, when Valentine's Day comes, if we don't take action and we're not kind, sweet, get the chocolates, the flowers, plan the date night, us knowing it's Valentine's Day makes no difference at all. So this is my invitation to you, that you are going to learn some things during this presentation that you didn't know about before. So rather than just store that in the knowledge bank, my invitation to you is to use it going forward. You're going to hear me use the term hard money and private money. Really quickly, what those are: it's tomato, tomato, six in one end, half a dozen in the other. At the end of the day, what a hard money loan is, or a private money loan, it's simply a mortgage. More often than not, it's a first lien mortgage that's collateralized or secured by a property. So an individual is approved for the loan, and the property secures the loan or acts as the collateral for the loan. So don't overcomplicate this. The difference between a hard money loan and other loans, there are differences there. But at the core of what is a hard money loan, it's just a mortgage loan with different loan terms. So when do you need hard money? What is hard money? How does it work? And why do you want to use it? So there's really four reasons to utilize private and hard money lending. Reason number one is you don't qualify. You as an investor don't qualify, whether that's based on income, credit, assets, whatever the case might be, but you don't qualify for a traditional loan from a bank. So insert private or hard money loan. Second reason, and the reason most often utilized for private hard money lending, has to do with the condition of the property. It's that the property itself doesn't qualify. See, if a property is in need of major renovations, things like mechanical repairs or structural repairs, then you're unable to get a traditional loan because it won't pass traditional appraisals, whether it's a Fannie Mae, Freddie Mac, or any other type of appraisal out there. So what you have to do is you have to buy the loan cash, or you have to utilize a private hard money loan, somebody else's money. Now, third reason has to do with speed, is you want to close fast. Traditional loans take anywhere from 10, 15 days if you're working with a good lender like Blink. Now, if you're working with banks or online lenders, those timelines can be pushed to 30 and 45 days. Hard money loans, we can close them in as little as 3 to 5 days. Others can close them 5, 10, 15 days. So speed can close much faster. And then another big reason has to do with conservation of capital. See, if you find a property, let's use an example, a $200,000 purchase price for one of your clients or for yourself as a realtor, and then what happens is it needs $100,000 worth of repairs, and the future value or the after repair value, which we'll get into here in a bit, is going to be worth $400,000. So here you're buying a house for $200,000, 100 in rehab, it's going to be worth $400,000. If you're to do a traditional loan, you would have to put down 20% or more on the purchase price, the $200,000. So that'd be $40,000. Then you would have to do the renovations out of your own pocket for an additional $100,000. So that 40,000 plus 100, 140,000. We're not even going to take into account any closing costs. So that was always the traditional way to do loans, if you could even get a loan. And rewind to reason number two is the property doesn't qualify. And when the property doesn't qualify, well, there's no loan to get whatsoever. So let's recap those four reasons. Reason number one is you or your client, the person purchasing the property, doesn't qualify for credit, income, assets, or any other reasons. Number two is the property doesn't qualify. It's in need of major renovations, either mechanical or structural. Three is you need to close fast. You just don't have the traditional timeline of 3, 4, 5 weeks to close. Closure is coming up, or sale needs to happen quickly. You just have a matter of a few days. Private hard money lending can fill that gap. And then the fourth reason is you want to save your money. You don't want to put down 20% on every property that you're buying. You don't want to have to do the repairs out of your pocket. Instead, you want to use OPM, other people's money, utilize their money, pay them an interest rate for that, and then move on to other projects that you can do. So now we went over what hard money is, went over when you want to use it. Now, where do you find the deals? Because that is number one. We always have clients go, Paul, what should I do next? What you should do next is go find a deal, because your LLC is great. Your website is great. Your business tax returns are great. Your team is great. But without having a deal, none of it matters. So where do you find deals? Just look for deals. They're everywhere. As realtors, you're driving to appointments, whether it's a buyer's appointment, whether it's a seller's appointment. And as you're driving by each of those houses, there are houses that have taller grass, there are houses that have mail sticking out of the mailbox, there are houses that have deferred maintenance, newspapers in the driveway. Those houses are the houses that you're going to see being fixed and flipped by a real estate investor in your neighborhood, or if it's not your neighborhood, in a different neighborhood that you're going to drive by again. And we've seen it happen time and time. I mean, just think right now of where you live and think of how many times houses in that area have been purchased or redone to where the opportunity could have been yours. Our office is here in the Houston Heights. I can tell you we drive by them all the time. So where to look? Open your eyes. They're online. Facebook Marketplace is extremely underutilized when it comes to seeking investment opportunities. It gets dismissed when there's so many investors, and we work with them, that are finding deals on Facebook. They're finding deals online, whether it's HAR, whether it's Zillow, Homes.com, Realtor.com, because this whole idea that you can't find good deals online, that's just not the case. You have a motivated seller. Now it's just up to you to come to terms with what deal is best for you and best for them. So as you're driving, look. As you're online, look. Other places where you can find them. Look, investors, we love to sell properties. There's a lot of investors right now that have deals they like to get rid of for whatever reason. Most of the times, I just want to move on to something else. It's old, tired of it. I just want something new. So look to other investors. Wholesalers, if you're not working with them, you should start. Are all of them good? No. Is every realtor good? No. Is every doctor good? No. Is every loan officer good? No. So every profession is going to have those that are better and those that are not. So you aligning yourself with wholesalers that can find you below market deals is extremely important. Now let's take a step back for those that don't know what a wholesaler is. A wholesaler is simply this: someone that goes and obtains a contract from a seller of a property and then sells the purchase rights of that contract to somebody else. So a wholesaler will go knock on a door, do some online marketing, whatever the case is, and they get a purchase contract. And that purchase contract is between them and the seller of the property. Well, what you might not have known in the state of Texas is you can sell your rights to purchase the house. So the wholesaler, what they'll do is they have a contract with the seller to buy for X amount of dollars. They'll in turn sell you the rights to the contract for an amount above that contract. They make their spread. That's their commission. They do this all the time. They're constantly looking for deals. So being on wholesaler lists and getting a constant stream of deals is a very smart move to make as a real estate investor. Does it mean you're going to get great deals every time? No, it doesn't. But going through those deals, you've heard the saying before, you're not looking for a pin in a haystack or a needle in a haystack, but it can feel like that at times. With that being said, we've been doing this a long time, and there are tons of deals that are found through wholesalers. Now, driving for dollars. This should be a realtor all-time favorite right here. You're already driving your clients to houses. You're already going to showings. You're already driving to the seller. You're already taking your kids to school. You're already driving to baseball practice. As you're doing your day in and day out work, why would you not look at properties, and when you see the mail that's piling up, when you see the newspapers in the driveway, when you see the deferred maintenance, why not go up, knock on the door, or just jot down the address, skip trace it later, reach out to them, see if they're interested in selling the house. Most opportunities are had by real estate investors finding introverted sellers who just don't know what to do. The extrovert seller is going to go online. They're going to call the realtor. They're going to talk to their neighbors. They're going to be, well, aggressive in the matter of trying to sell their property. An introvert buyer is going to sit there and wonder, or an introvert seller rather, is going to sit there and wonder what to do. What should I do? How do I get rid of this? And they almost have this paralysis by analysis to where ultimately nothing gets done. So here comes a real estate investor, knocks on the door, says, hey, I'd like to buy your house, or whatever the script might be. And all of a sudden, they've got the home run deal of all deals because nobody else did it. Neighbors, talking to them is great. If it's not them selling the house, they have a family member, they have a friend. Look, life events happen to people, and talking to attorneys is another real good option. Divorce attorneys, probate attorneys, bankruptcy attorneys. These are all life event attorneys that assets like houses typically end up needing to be split during that. And again, talking to friends, posting online, and just fill in the blank. There's tons of different ways out there that you can find deals. Now, how much can I borrow? This is a question that I get asked all the time as a mortgage broker. So as a real estate investor, knowing your acquisition power is extremely powerful. You wanting to buy real estate and not knowing what you qualify for is just a formula that doesn't line up together. And so I always get asked, Paul, how much money can I borrow? How much money do I need to bring to closing? And well, I love this formula right here, and I've been working on it for over a decade now. And it's simply this: money I need versus money I get. Whenever you're purchasing a property, you're always going to need acquisition money, money to buy the property. You're going to need rehab money, money to repair the property. And then, of course, whether you're buying it cash or with a loan, you're going to have closing costs. So you always need three types of money when buying a house: purchase, renovation, closing costs. Now that's money I need. Money I can get when it comes to private hard money financing. You're able to borrow based on the after repair value, the future value of the house. So although you're buying the house for this price today and you're going to renovate it for this price, what are you selling it for later? Commonly referred to again as the ARV. So once you have this formula here, we're just simply filling in the blanks. So to utilize an example, it's going to fill all these in. To utilize an example here, we have a purchase price of $385,000. Sorry, we have a purchase price of $335,000. Renovations to upgrade and renovate this property are $85,000. Closing costs are about $16,000, and then our after repair value is going to be $595,000. So when it comes to a loan here, what we're going to do is we're going to utilize 70% of the after repair value. 70% of $595,000 is $416,000. Now, if we go over to money I need, we needed $335,000 to buy it, $85,000 to renovate it. Adding those numbers together, we have $420,000 plus $16,000 in closing costs. That's $436,000. So we have two numbers here. We have money I need, $436,000. We have money I get, $416,000. So the difference of the two is $20,000, that being the cash to closing. That's how private hard money loans work. So let's look at the numbers again, because twice is nice. Now, what you're going to do is you're going to draw a line down the middle of the page and then a line at the top across. Left side, what you're going to do is write money I get need, right side, money I get. Under money you need is purchase, rehab, closing costs, total. Money I get, 70% of the after repair value. After repair value equals 70% of that for a total. So the numbers that we have here, it's $145,000 purchase price, $40,000 renovation, closing costs here, $11,000, lower amounts. The lower you borrow, the less your closing costs. The more you borrow, the more your closing costs, right? So again, $145,000 to buy it, $40,000 in renovation, $11,000 in closing costs. Total money we need to buy this house, $6,000. Now the after repair value is $270,000. So we take 70%, $270,000. That's going to give us $189,000. So again, we have our two numbers. We have money I need, $196,000. Money I can get, $189,000. The difference in the two, $7,000. That's what we bring to closing. So anytime you're working through a deal and your client asks you, hey, how much money would I need to put in this deal? Or you yourself are analyzing a deal and you're wondering, how much money do I need to put in this deal? To simply work this formula right here, and you'll be just about as close as you can get without being 100% accurate. Now, in being 100% accurate, we have these calculators on our website. And so real quick, our website's blinklending.com. That formula is a simple formula, but sometimes you need to be reminded. At the top right here, we have calculators. And you simply go to calculators. We work with homeowners and investors, as I mentioned. So here we have our investor calculators are below, and then our homeowner calculators are above. But if you do this fix and flip calculator, it'll run through the purchase price, the renovation budget, your after repair value, loan to value, and then you can run true ROI numbers. How many months is it going to take for you to sell this property? Are there any commissions that you're paying at closing? Are there any commissions you're paying or at the purchase on the sale? How much was the insurance? What are the annual property tax amount? All these figures will come over here to the right side. Will let you know how much your closing costs are, loan amount, interest rate, funds needed, what you're bringing to closing, what your carrying costs can be expected to be. And what's really cool is your total profit and then your final ROI, which of course is return on investment. We're talking about cash to closing, and the formulas that we have, although accurate, they're not as accurate as this preliminary HUD is right here. And this preliminary HUD, for those that remember what a HUD sheet is, the closing disclosure replaced the HUD, although HUDs are commonly used today, is this will give you about as accurate as you'll get before going to the actual closing table. It's just within a few dollars. So utilize these calculators should you ever like to. And all right, so people want to know, hey, how much money can I borrow? We covered that. Next question clients have is, and investors have is, what are my payments? Well, payments a very easy way to figure this out. Just simply take your interest rate, divide it by 12 months, number of months in the year. Whatever that number comes out to, simply multiply that number by your loan amount. So, for example, your interest rate's 11.99. You divide 11.99 by 12 months. That's going to give you about 1% per month. Now pretend your loan amount's $200,000. 1% of $200,000, $2,000 a month. That easy. Pretend your loan amount's $300,000. 1%, $300,000, $3,000 a month. Just 1% when the interest rate is 11.99. Now what happens when it's not? Let's pretend it's 9.99. Well, very simple. 9.99 divided by 12, that gives us 0.8325, and we're going to multiply 0.8325 by our loan amount. So 9.99 divided by 12 equals 0.835. 0.8325, and then multiply that by the loan amount. In this example, $300,000. It's going to give you a payment of $2,498. Let me say that all over again. So 9.99 divided by 12 is going to give you 0.8. Then you're going to take that number, multiply it by the loan amount. In this example, $300,000, and what you're going to get is a monthly payment of $2,498 per month. All right, so we went over how I won't go to the website, but you get it, right? We have another link on our website to where you can run the payments. So if you forget the calculation, you're on the phone with one of your clients, or you yourself are analyzing a deal and you need to know numbers, can't get us on the phone for whatever reason, just go to our website, calculators at the top toolbar, and just run your numbers until you're happy. Money I need, money I get, what's my payment, where do I find deals, what is a hard money loan, when and why do I need it? That's what we've covered so far. So when do real estate investors make money? Well, you make money when you buy. Make your money on the buy, not the sale. This is true in any investment, whether it's real estate, business, or the stock market. And whenever you have a good deal, if you tie that to bad financing, well, that good deal is going to turn bad very quickly. But if you have a good deal and you tie it to good financing, well, that deal is just going to stay good and it might even turn out great. So where do good deals start? Well, the good deals start with a good purchase price, good acquisition price for the property that you're buying. Now, if you're going to get financing that's tied to it, good financing starts with your credit score. Us lenders, whether we're here in Texas, whether Alaska, or anywhere in between, the question that we always want answered is this: are you going to pay us back? What is the likelihood that you pay us back? See, it's not the return on our money that we're interested in. First, we're interested in the return of our money. We want to make sure that whatever money we put in, we're going to get that back. Once we know we're going to get that back, now we can talk about the different returns and the gains that we're going to get. So the best way that mortgage lenders can tell whether you're going to pay them back is by looking at your credit score. Why? Well, your credit score, our credit score, is our numerical representation of our ability to do what we said we're going to do. I'm going to say that again. Our credit score is our numerical representation of our ability to do what we said we're going to do. And when you, an investor, are borrowing money from a lender, what you are doing is you're saying, hey, I promise I'm going to do what I'm telling you I'm going to do, which is pay you back. Well, great. People with good intentions make promises. People with good character keep those promises. And a way to find out, are you a promise keeper, is looking at your credit report. So I get asked this question, Paul, what should I do? What's my next step in real estate investing? What should I do? Go find a deal. That's step number one. Well, Paul, easier said than done. I agree. Step 1B is get your credit score above a 780. Because when your credit score is above a 780, and now you do find the deal, and it's a good deal, because why would you buy a bad deal? You're going to get that good deal, and you're going to take your great credit score of a 780 plus, and you're going to go get good to great financing with it. And when you pair good deal with good financing, well, that's a recipe for it turning great. So while you're waiting for a deal, whether it's your first deal you're waiting on, whether it's your fourth, fifth, or anything in between, always pay attention to where your credit score is. Because again, in real estate, you make money when you buy. And the last thing you want to do is pair an awesome property with a bad loan and just watch your profits get eaten up by interest rates that, well, you're deserving of paying because your credit score doesn't represent that of a borrower that should get good interest rates. So how's the credit scores broken down? Whether it's us or whether it's any lender in Texas, Alaska, or anywhere in between, we work on the same credit score tiering system. Now, that's the same credit score tiering system. It's not the same interest rate system. And what that tiering system says is between a 780 and an 850, you get the best of the best interest rates that that individual lender has to offer. Again, it doesn't mean that if your credit score is a 799, that you're going to get the same interest rate with every mortgage lender you work with. No, it means each lender that you work with is going to give you the best rates that they have to offer in that credit score tier range. Now, tier 2, 760 to 779. Tier 3, 740, 759. Tier 3, you get it. It goes down in increments of 20 all the way to a 620. I'll tell you that the line of where things really turn is a 680 and below. So 780 and above, you're going to get the best rates. And then it goes second best, third best, fourth best, fifth best, all the way down to 620. But we see a real shift at the 680 mark. So if you, as an investor, have a credit score that's below a 680, work to get it up. If you're at a 720, work to get it up. And then if you're a 780 above, congratulations, keep it there. So moving on, how do mortgage lenders make money? Well, mortgage lenders make money two different ways. We, mortgage lenders, I'll say it again, make money two different ways. By the interest that we charge you for the money that we've lent you, and by the fees that we charge you for the money we've lent you. So interest, we get it. What's my rate? How much am I borrowing? That's what my payment is. That's what I paid the lender. But the fees is what you don't know about. And the fees is really where your profits get eaten up and where your deal can turn from a home run deal to, wow, the lender actually made more money than I did in this deal, which happens over and over and over. So 3 times you as an investor are going to pay fees. And that's before closing, at closing, and after closing. Before closing, you want to be aware of things like application fees, commitment fees, appraisal fees, and any other fee that they can come up with to charge you before you actually go to the closing table. We at Blink Lending, we don't charge you any application fees, no commitment fees, and you do not pay for appraisal fees on any of our hard money loans. So when it comes to fees before closing, when you're working with us, the answer is 0. Now, fees at closing that you can pay. These are things like loan origination, very common. Underwriting fees, very common. Processing fees, common. Admin fees, common. Loan servicing fees, common. And then anything else that a lender can throw in as a junk fee to increase the profits. Well, look, we're good at it. We're going to do it if we can get away with it. And take us out of it. Put in your car dealership. Put in your mechanic. Look, if you let them get away with it, they will get away with it. So what are typical loan terms that you should be paying as an investor when it comes to borrowing hard money? Middle of the road origination is anywhere between 2 and 3%. At Blink Lending, we charge 2.5%. Underwriting, I've seen underwriting be as low as $800. I've seen underwriting be as high as $2,000. Underwriting with us at Blink Lending is $1,295. Processing, I've seen processing as low as 400. I've seen it as high as 1,500. We charge 0. Loan servicing fees, I have seen this fee be as little as $100. and I've seen this fee be as much as $4,000. This is a huge fee that is gaining more and more steam in the private and hard money lending world that you as an investor should definitely be looking out for. And then any other kind of admin or creative fees that a lender is going to come up with to say, hey, this is a fee that you have to pay because of this is, well, a fee that you should try to avoid. So the only fees that you're going to pay with Blink at closing, typically 2.5% origination, $12.95 underwriting, zero everything else. So we covered before, we covered at closing. Now let's talk about after closing. And after closing, this is where it gets really, really bad. You likely don't know that there are things such as inspection fees, draw fees, the wire fee to send you the money, a payoff fee to generate a document that tells you, the borrower, what you owe the lender. Yes, lenders actually charge you a fee to tell you what you owe them, as asinine as that sounds. Extension fees, prepayment penalty fees, paying interest on money that you've never borrowed before. Why would you ever do that? It just doesn't make sense to me. So after closing is when investors really get their profits eaten into without knowing about it, because they didn't ask the question at the beginning before they started the process, which was, hey, tell me about your closing costs. What are you charging me before closing? What are you charging me at closing? And then what fees can I expect after closing? And the biggest fee that'll eat into investors' profits is paying interest on money you haven't used. Again, the biggest profit eater for real estate investors is paying lenders interest on money they haven't borrowed. That concept it's hard to wrap around my head. So use this as an example. You have a credit card right now in your wallet. That credit card says you can use up to $20,000. Now, month one, you use $2,000, but yet the credit card company sends you a bill and says, hey, you owe us interest on $20,000. You would lose it. There is no way you would agree to pay interest on the $20,000 when you only used $2,000. So if you'd be that furious when it comes to a credit card and an amount of $18,000, why would you allow a private or hard money lender to charge you interest on $100,000 of undrawn rehab budget? So, and I'll explain that a little bit more in here in a second, so the numbers all tie together. Draw fees, inspection fees. What this simply means is when you are completing renovations, when an investor is completing renovations on a property, and they have an amount to repair the property withheld in an escrow account, that money is withheld by the lender. It is not given to the client up front. It's not given to the investor up front. The money is withheld in an escrow account, similar to construction loans. And then as the investor is completing the said renovations, they're going to receive those amounts in draw reimbursements from the lender. Now, the lender is going to need to check the work to make sure that the repairs and the renovations that the investors said they were going to do was actually done. When they do that, they're going to send somebody out to take pictures and videos. That person is going to charge a fee. Now, depending on how many times that person comes out, that fee could add up to quite a bit of money. Servicing fees. This is a fee that you pay your lender to collect your payment. I mean, try that on. You're going to pay your electric company, but when you pay your electric company, there's a surcharge on there that's a fee charged to you for them collecting the payment from you. I can't make this up. There are lenders that lend you money and they charge you a fee to pay them interest on the money that you've lent them. Why would you pay that? Don't. Prepayment penalties. If you do such a good deal, you finish the renovations fast, or you buy the property and the next day the neighbor wants to buy it from you and you turn around and say, hey, I want to sell it, paying a prepayment penalty, meaning you have to pay a penalty for paying off your loan early. You want to be aware of all these fees that you'll pay after closing. So let's add all these fees up just to see what significant difference they make. I want to go back to the example we had earlier today, which was we're purchasing the house for $385,000. Keep saying 385. We're purchasing the house for $335,000. $85,000 in renovations. Our closing costs, we estimated them around $16,000. So when I add 335 plus 85 plus 16, I get $436,000. Then my after repair value was $595,000. 70% of that is $416,000. So now I've got my two numbers, 436, what I need, 416, what I can borrow. The delta, the difference in the two being $20,000. That's my skin in the game. But we want to talk about those fees before closing and fees at closing and fees after closing. So pretend with the lender that you paid an appraisal fee, about $700. So now before closing, you're already 700 in the red. Now at closing, you paid standard origination, 2.5%. You paid an underwriting cost, but they have an additional $500 processing fee. So now that 700 and that 500 has turned to $1,200 in extra fees. Now we're going to go after closing. And if you rewind these slides a little bit, we found out that your payments are about 1% per month. So if the loan amount here is 416,000 and your payment's 1% per month, that means your payment is what? $4,160. Very simple. Except we talked about fees that you pay after closing that you're unaware of. One of those fees is paying interest on money you didn't borrow. So if I told you a few moments ago that when your loan is set up for $416,000, but that $85,000 to renovate the property is withheld in an escrow account and not given to you in advance, have you technically borrowed that $85,000 yet? The answer is no, you haven't. Your loan amount is set up for $416, but truly what you've borrowed is that minus $85,000. 331 is what we have as that's how much you've borrowed right now is $331,000. So if you're making a 1% payment on $331,000, that means your payment is going to be $3,310. Compare that to $4,160, and we're looking about an $850 difference per month. So until you start drawing that renovation money, you're paying interest on money you haven't even received. So $700 on the appraisal, $500 on processing, $850 month one on paying interest on money you haven't got. Now I get it, Paul, I'm going to work really fast and I'm going to start drawing money. How much can you really draw in month one? Let's just call it 20 grand. So now you've taken 20,000 out. Means month two, you're paying interest on what? $5,000 that you haven't borrowed. Because if we have that 85,000 sitting aside here, I subtract 20,000 from that because that money was given to the investor. Well, now there's 65,000 left. Paying interest on that money that you haven't borrowed. So 850 month one, 650 month two. How'd I get 650? 65,000 times 1%, $650. That gives us the additional payment. So I add that onto the 850. All of a sudden, I'm at 1,500. Let's go to month two, another 20,000. Month three, another 20,000. Look, you're at another $700 there. So with just quick math, we're well over $2,000. Now, each time you're making a draw request, it's costing about $150 to $200 to receive that money because that inspector has to go out there, has to take pictures, videos, look at the work, prove the renovations that were done. So they're going to charge 150 to 200. Let's just go 150 for low math. Let's say you did that 4 times. 4 times 150 is another $600. So now I add that on top. Then there's a payoff fee. Then there's a loan servicing fee. Look, I don't want to drag this out anymore because I think I've made the point here. But what you're doing is you're paying thousands of dollars extra in fees here that you could either keep as profits for yourself, or you could use that money to now spend on your marketing efforts to go get another deal. So either way, you're losing. You're either losing the pure profits that you could just put in your bank account and do nothing with other than keep and enjoy the fruits of your labor, or you could take that money, invest it in your marketing efforts, and have that deal multiply into other deals. Either way, it's not that we don't know the answers to questions, is that we don't know the questions to ask to get the right answers. And there are conferences that are had every year. It's called the Private Lenders of America Conference, American Association of Private Lenders. I belong to it. It's a conference. It's in Vegas once a year. There's a guy that goes up there and talks about all the different fees that private lenders and hard money lenders can charge their clients to increase their profits. Look, I get it. It's business at the end of the day. But you, as a consumer, need to be an educated consumer. And in real estate, you make money when you buy. And when you're buying a property that has financing tied to it, if you're not asking these questions up front and getting these answers in advance, you're going to be stuck there paying these fees going, I didn't know, why didn't you tell me? And I don't know, why didn't you tell me, has never paid anything for us. So the questions that you should ask, and I'd be happy to send this to you, is how long are your loan terms? See, hard money lenders are notorious for doing 6-month loan terms only. That $85,000 rehab, I would argue that should be a 9 or a 12-month loan term. Because depending on where it is, depending on the time of year, depending on the scope of renovations, is it holiday times? Things are slowed down. Is permit needed? That's going to slow things down. Is it major mechanical repairs that are being done to the property? That's going to slow it down. What type of materials are needed? That could slow it down. So to do this one size fits all and utilize 6-month loan terms across the board in these one size fits all loans, a 6-month loan term may not be enough for you. You may need a longer loan period, but they're going to tell you loan terms based on a 6-month period, because what happens after the 6 months is over with? Well, these things called extension fees. And extension fees can just pile on and pile on. So our loan terms, 6 to 24 months. Do your loans have any prepayment penalties? You always want to know, if I pay this loan off early, is it going to cost me a penalty? With us, the answer is no. Now, what if I don't pay it off early? What if I paid off a month later, 2 months later, 3 months later? Are there extension fees? And if so, how much? And now look at the project timeline that you have, because I mentioned holidays. I mentioned types of repairs. I mentioned weather restrictions, but what about area restrictions? Some areas we have days on market that are 15 days. Other areas we have days on markets where they're 90 days. So your loan should align not only to the timeline that it's going to take you to renovate the property, but also line up with the timeline it's going to take for you to sell the property. And if there are extension fees, how much are there? Because are you saving today to just pay later, when in reality you should have went to another lender that wasn't charging you those later fees? Possibly. Now, is there a draw schedule? You want to know that. Am I able to draw as I like, or am I restricted to how I can draw and receive the funds that I'm asking for? Do you charge draw and inspection fees? We covered this. Each time an inspector comes out to the property to take a look at the property, to make sure that it was done correctly, the repairs were done as they said they were going to be done, they're not coming out there for free. So when they come out, how much are they charging you? Is it $150? Is it $200? Is it more? You want to know this in advance, because if you have a $20,000 rehab, it may not matter to you. But if you have a $150,000 rehab budget and you're going to be making 7, 8, 9 draw requests, knowing how much those draw requests are is super important to your overall deal, as it can eat into your profits. And profits, is that not why we're doing this? I mean, why are you investing in real estate? To make money. And if you're not going to pay attention to the profits, then why do it all together? Next question. How fast do you disperse your draw requests? Look, your contractor wants to get paid yesterday and they want to continue tomorrow. That's just how it works. So if you're waiting on funds to pay your contractor and it takes you 1 week, 2 weeks to get your funds from a lender, now it's going to take your contractor 1 or 2 weeks to get paid. I'm telling you, they're moving on to another project and they're unlikely to answer your call when you call them. Lenders love throwing this one in there. Is there an additional fee, a wire fee, to send me my money? So here you are, you're going to make a draw request. You completed $25,000 in renovations. You call your lender. You say, hey, lender, I did the $25,000 in renovations I said I would do. Please send your inspector out. Lender says, no problem. They'll be there Tuesday. Comes out Tuesday. They're charging you money for, they're charging you money for that trip to come out. Let's pretend it's $150. Now, when it comes time to wire you the money, they're going to charge you another $30 or $50 to wire you the money. So not only are you paying a draw fee and an inspection fee every time, but then you're paying a wire fee in addition to the inspection fee. Stop it. Ask these questions in advance to make sure you're getting the best loan for you. Next question to ask is, do you charge a monthly servicing fee? Look, this one really chaps my you-know-what. Lenders charging money to a borrower for the borrower making a payment to them is just as asinine as it gets to me. Why on God's green earth? Could you imagine paying your electric provider a servicing fee for paying your electric provider? Could you imagine paying a servicing fee to your cell phone company for paying them money? Well, your mortgage, your hard money mortgage lender shouldn't be any different. You making a payment to them shouldn't cost you money. It should just be part of the loan terms and they should just accept it. So we don't charge any payoff fees. We don't charge any wire fees. We don't charge draw fees. We don't charge inspection fees. We don't charge you prepayment penalty fees. We rarely charge you extension fees, depends on the deal. And we don't charge you any service fees. The payoff, we've talked about that. That's lenders generating a document that tells you what you owe them. Lenders charge you money for that. And then lastly is the most important one, without a doubt, is, are you charging me interest on my undrawn rehab budget? If we go back to the example of the $85,000 in renovations, that investor, if they were smart, they would not be paying interest on that $85,000. Also, if they did a little bit of shopping, reached out to us, not only would they not pay interest on that money that they're borrowing, but they wouldn't pay draw fees, they wouldn't pay inspection fees, they wouldn't pay wire fees, they wouldn't pay servicing fees. What fees do you pay with us after closing? Rarely do you pay extension fees. That's it. You don't pay any other fees with us. So again, in real estate, you make money when you buy. Now,